Our first speaker from Landbay is Rob Stanton. There's a picture of him wearing maybe a COVID tash, I'm not quite sure. You should have already received the product guide. Looks a little bit like that. So just grab hold of that. That's an 8-page document, which, Rob, you'll be pleased to hear, does include your changes from Tuesday that were launched. We managed to actually get the changes made. So on page 3, and I've also changed your slide, by the way, so it's got the correct rates for the 2-year fixed. So
thank you very much.
Apologies, I did that last night, so I didn't get a chance to contact you. Okay, so a little bit about Rob, first of all. When this decides to load. He's head of sales for the Midlands division of Landbay. Joined Landbay in August 2018, but was 15 years at Paragon Bank. His area of expertise includes specialist buy-to-let and that should say buy-to-let, I should say but-to-let underwriting process. Okay, that wasn't my mistake, believe me. So he knows his stuff in but-to-let, apparently. His extensive experience means he's equipped to provide brokers with the support they need to process clients' applications. On to his interesting fact, he's Landbay's resident footballer and has played against a number of ex-England internationals. Same as me, Rob, I played against a number of England ex-internationals at cricket, but probably not as successful as you did. Has played at the majority of Premiership grounds. He now tortures himself by watching Aston Villa. Okay, well, I'm a West Ham fan, so believe me, I feel your pain. Okay, so we will now just load up the presentation, and apologies for the delay, Rob.
That's okay, Tony. Thank you.
Then, once it's in, I'll then click off and see you in about 20 minutes. It's all yours.
Brilliant. Thanks, Tony. Good morning, everybody. Hope you're all well. Rob Stanton from Landbay, as Tony introduced. I'm just going to spend a little bit of time this morning just giving you an overview of what Landbay do, where we sit in the market, where we're currently seeing business coming into us, and hopefully how we can help you and your clients moving forward in these times. So, who are Landbay? We're a specialist buy-to-let lender, and the question I get asked by a lot of introducers is, who do you sit closely to? Who are your competitors? So, Kent Reliance, Precise, Paragon Bank, Lendinvest, Fleet. We kind of wrap ourselves around them competitors. So we sit very much in the specialist side of the buy-to-let market. It was launched in 2014, so you might have seen us around over the last kind of 12 to 18 months, becoming more and more popular. We're getting more and more competitive products out there on the sourcing system. So hopefully when you are doing your sourcing systems, you're seeing Landbay appear more and more. So it's a great opportunity for me today to really give you an overview of why you should use us and what some of our key USPs are. So we're based in London, in Victoria, on Buckingham Palace Road. So it's always nice visiting the head offices whenever possible. We are a fintech lender. So everything is based online. We're a paperless lender. So we have been able to lend throughout the pandemic. Our underwriters are currently working from home still. And as we're a cloud-based lender, everything is available for the underwriters. So our SLAs are stopped within 24 to 48 hours throughout the whole process. So as Tony mentioned earlier, there has been some service delays across the sector, and that's mainly some of our big competitors who have got older systems, who have been unable to really do their jobs at 100% capacity. So here at Landbay, we've been able to lend throughout the pandemic. We've kept our service level agreements fantastic, and long may that continue. So why should we be using Landbay and some of the benefits that we offer? So what I'll do is I'll go into further detail a little bit later in the presentation in some of the benefits of why using Landbay, but these are a few hot topics and some key USPs for us. So we've got some experienced buy-to-let underwriters, which you get direct access to. So once you submit an application form into Landbay, you will have the direct number and email address of the underwriter who's dealing with your application. So when you do need to phone into Landbay, you won't have to speak to a telephone call, a telephone team, or an experienced underwriter. You will actually speak to the underwriter who's dealing with that application. We find that enables the SLAs and the time from application to offer and to completions to be a lot quicker. Because if you have got a question, you can pick up the phone, that can be satisfied within 20 or 30 seconds. So instead of you having to phone a help desk, you're waiting 4 or 5 minutes to get through to somebody, and then they have to pass a message on to the underwriter. We've eliminated that process. So you've got direct access to our underwriters. Again, case ownership. So that same underwriter will deal with that case all the way through the mortgage application process. And again, we have a very experienced account management team. All of our BDMs across the country have got pre-existing experience in the specialist buy-to-let market. So they're very open and au fait with your HMOs, your limited companies. So if there's anything you're unsure of, pick up the phone. We're more than happy to help and guide as much as possible. As I mentioned earlier, our turnaround times are 24 to 48 hours. Our whole process is online, and we don't have any certification of documents required. So it could be uploaded onto our portal, or it can be emailed directly across to one of our underwriters. So some of the criteria highlights: we lend to HMOs up to a maximum of 12 bedrooms. And again, we also lend to multi-unit freehold blocks up to a maximum of 12 units. So potentially that can be 12 flats on one freehold title, or it could be up to 12 houses on one development on one freehold title, which is really, really competitive in the market. And what you'll find in that type of criteria for us, we're not priced as highly as some of our commercial competitors. We do price on the buy-to-let scale. So when you are sourcing HMOs and multi-unit freehold blocks, you will see Landbay appearing very, very good and very high up the sourcing system. We're still offering lending to new build flats, houses, and conversions. It's a little bit of the area where some of our competitors have kind of stepped back away from because they was unsure what was going to happen to property prices, obviously post-pandemic and post-lockdown. Landbay, we're still in that market, and we can consider up to 75% on new build houses, flats, and conversions. We also don't have an upper limit on stories. We do expect that anything over 5 stories does have a lift, but again, we haven't got an upper limit. So if you've got a high-rise block of 20 or 30 stories, we're more than happy to consider that type of property asset, which is good. What we do offer as well, we do a pre-application check on any properties as well. So if you've got a property which might be above commercial, next to commercial, or it's just a high-rise flat which it might have been knocked back by another lender, you can email myself or the local BDM and we'll pre-vet that application for you. We'll speak to our underwriters, we'll speak to our local surveyors, and we'll try and get an understanding if it's something that we'll be able to lend on. So instead of you submitting the application and seeing, we're happy to kind of have a look at that application pre-submission, so it saves you a lot of time in the process. Day one limited companies is also acceptable to us, and we can consider 1.5 million loans up to 70%. So for your higher loan amounts, again, we are definitely in the market for that and sourcing very well. Our 5-year fixed rates are calculated at pay rate, which I'll move on to a little bit later on in the presentation as well. And we also do day one remortgages. Capital raising only excludes tax and gambling debts. So again, we're still in the market for capital raising for clients to raise money to buy that onward going residential property or buy-to-let property or a development plot of land. So a lot of our competitors, again, are getting a little bit more stringent on capital raising. Some lenders aren't offering capital raising for any onward going purchases. We're happy for the clients to potentially capital raise money without that ongoing purchase actually secure. So it really enables a client to be really flexible and act really quick when a property does enter the market, especially in these times when landlords have got a deadline at the end of March for the stamp duty. If they've got that deposit in their bank, it really helps them when they are bidding against other bidders. In regards to tenants, we can consider DSSS tenants and student lets as well. Happy with first-time landlords. So obviously, as long as they're an owner-occupier and own a residential property, we're more than happy to help first-time landlords get on the ladder and start building their portfolio. In regards to our HMO multi-unit freeholds criteria, we do ask that at least one of the clients have 12 months lettings experience. Obviously, HMOs and multi-unit freehold blocks have a lot more management requirements than your standard single self-contained unit. So we would like one of the clients to have owned a buy-to-let property in the past, so we can get comfortable that they do understand the regulation around HMOs and multi-unit freehold blocks, which I will move on to again a little bit later on in the presentation. Interfamily sales is something that's becoming a little bit more popular as well. So you might have mum and dad who are potentially portfolio landlords, and they're looking for future inheritance and tax reasons to start moving some of their property assets into their children's name. We're more than happy to consider that type of transaction. It would have to be done as a purchase at full market value, but we would happily accept the equity that's held in that property to be used as a deposit. So potentially the son and daughter hasn't got to have the 20 or 15% deposit held in a bank account. We're happy to use equity that's been built up in that property to be used as a deposit. We also have some tracker rates with Nowhere RC. I think there's one other lender in the market in the specialist arena who offers this kind of product. So it's really good for your clients who potentially aren't sure if they want to hold it for 2 or 5 years, but it gives them the option to remortgage to us, potentially off a development loan or a bridging loan, with the hope to let in that property for 6, 12 months. But it also gives them the flexibility that in 12, 18 months, if the market's recovered enough, or if they get good offers on their property, they can actually sell that property without incurring any ERC products. So if you have got landlords out there who are unsure of what they will want to do with that property in the short term, medium term, or long term, then we have got some options for them in regards to the tracker rates as well. It's not a short-term product, so we wouldn't accept it if the property was on the market or there was no intention to let it. We would want the intention of that property to be let. So some criteria highlights as well. So obviously landlords who own 3 or more properties now, lenders are stressing their background portfolio. So a lot of our competitors are stressing that portfolio, saying that if you own more than 4 mortgage properties, that portfolio has to meet 140 at 5.5%, and it can't be any higher than 75% loan to value. At Landbay, we haven't got quite strict stressing as some of our competitors. So as long as that background portfolio stresses at 125 at 5%, which is the old school ICR calculation we all love and remember, we're more than happy to lend to that client. And we don't have a loan to value maximum either. That's not saying we're going to lend on a portfolio which is geared at 125% loan to value, but it does give us that flexibility if the clients are holding old legacy properties since the 2008 crash, which haven't recovered as quickly as some of the rest of the market. So again, if you are struggling with some of the background portfolio checks, some of the lenders, please do bear us in mind. We're more than happy to help. Again, more than happy to pre-vet any applications for you. So just in regards to our HMO multi-unit criteria, there has been a lot of regulation changes around HMOs and MUFBs over the last 12 months, which I will move on to. But in regards to our criteria, as I mentioned earlier, we do require one of our clients to have a 12-month lettings experience. We can also look at gaps in experience. So if you've got clients who owned a property for 3 or 4 years and their plan was to sell that property to move into the HMO market, but they haven't quite found that yet, so they've sold their original property, we're more than happy to look at them kind of situations. We are a manual type underwriting, and we will look at the whole case and its merits. So we're not a black and white lender or a tick box lender that says it doesn't fit this element or it does fit this element. If the case is worth a deal, we're more than happy to have a look at it for you. So we can consider 75% up to a maximum of 6 rooms. Anything from 6 to 12, currently it is restricted to 70%, but we are hoping now the market is returning to some kind of normality, we can get back up to that 75% for some of the larger HMO type properties. Minimum property valuation on HMOs is 75,000, and our maximum loan is 1 million to 75%. In regards to our MUFBs, minimum value is 120,000 up to 12 units, and our minimum square footage per unit is 25 square meters. Again, that's quite a good criteria point. A lot of our competitors will say their minimum is 30 square meters. Right, some of the regulations that we've seen come into play over the last 12 to 18 months, you may be aware of them. If you're not, it'll be really good for you to kind of understand what they are. So when you are talking to your clients, you can point them in the right direction. So the first one is the Article 4, and this is a council's planning tool for controlling the number of HMOs in a specific area. So what does that mean? So that means that any property that is purchased after Article 4 has been implemented, it cannot be changed into a HMO or multi-unit freehold block. So if you've got a client who is looking to potentially purchase a property now with the hope to convert that property into a HMO at a later date, please bear in mind that they might not be able to if Article 4 has been introduced. You can check Article 4 legislation by going onto the local authority website, and you can do relevant searches. So if you are talking to clients who are potentially looking to purchase a property now with the intention to converting it, always spend that 5, 10, 15 minutes just doing your research on the local authority website to see if 1, the Article 4 has been implemented, or 2, there is talk it may be implemented. Any existing HMOs rented prior to the planning will automatically qualify, so there's no concerns. So if you're letting HMOs in, say Birmingham, where Article 4 has recently come into it, and you've been letting that property over the last 2 to 3 years, there'll be no change in the way you can let that property. Any gap in HMO means you potentially may lose Article 4. So if you've been letting a property for the last 2 years to students or professionals, and you change the letting arrangements of that property to, say, a family, and you continue to let that property for 12 months, you may have to go down the planning route and ask the council to accept that Article 4 legislation. Rarely councils give retrospective Article 4 planning, so they are really strict on it. It is becoming more and more popular now that councils are implementing Article 4. So it's just to bear in mind, if you are speaking to HMO type landlords, just to make them aware that Article 4 is becoming more and more popular, and to do their research. The second regulation that's recently changed is sui generis. It is a Latin word, and I speak to many people, and we all say it slightly differently. So sui generis is the way I explain it. It might be wrong, and this applies for any 7-bed HMOs. So any property which has got 7 or more bed HMOs, they need an HMO license, and they will now also need full planning permissions. So just because a landlord had a HMO license, it doesn't mean they get planning. So any landlord who purchases a 6-bed HMO and they want to convert it into a 7, 8, or 9-bed HMO, they will have to apply for full planning and certificate of lawful use. So it's an extra license that the clients will have to use. What this license normally entails is that one of the council officers normally goes around to their property, they inspect it to make sure the planning and the conversion has been completed to a good standard, and it satisfies all the health and safety requirements. So what you normally find is any 8, 9, 10 or 11-bed HMO is normally over 3 or 4 stories. So they have to make sure they have the relevant fire escapes, the fire alarms. We've probably all seen rogue landlords programs where landlords are letting 7-bed HMOs and there might be 13 or 14 tenants. And this sui generis is trying to really nail down that part of the market to make sure the properties are safe and they have the relevant planning permissions that are required. So again, you might not come across this situation a lot, but it's always good to have in your armoury if you are speaking to experienced landlords who may be wanting to move into the HMO sector. So here at Landbay, we do 3 separate valuation types. So we do a standard valuation, which is a standard single dwelling. So that's the 9 times out of 10, we will get a standard valuation report. So that's for your single self-contained units, which properties are going to be let to families. We also do an investment valuation, and this is a very popular investment valuations for our HMO proposition. And an investment valuation is normally conducted to properties up to a maximum of 6 beds. And the way the valuer actually conducts their valuation report is against the rental multiplier and annual rental income. So what we normally find in these situations is that the client normally gets a higher valuation.
Rob, could I just pause you a minute, because you're freezing and it sounds like you're playing a banjo at the moment with the way your internet's gone. So just to see if it just stabilizes for a second. I don't know if anyone else is having a problem. We just put in the typing message at the bottom. So I don't want anyone to miss what Rob's got to say for the next couple of slides. So there's 5 people typing, so can hear fine. Right, I'll ignore me because it must be my end then. So you carry on, please, Rob.
Great stuff. Thanks, Tony. So as I was saying, investment valuations, we look at investment valuations up to HMOs. So what you'll normally find is when you get an investment valuation back from a valuer, you will normally see an increase in valuation because the way the valuation is actually conducted is slightly different to a bricks and mortar. So it's an annual rental multiplier. So the property value will be calculated at anywhere between 8 to 13 times the annual rental income. Obviously, it's very difficult to really give you a 100% figure of where that will sit because every different region and every different council will have different kind of rentability demands. So if you're in an area where you've got a real good university, you will get a higher investment valuation report. So again, when you are considering lending or considering lenders who do HMO lending, always ask the question if they are doing investment type valuation reports. What I would say is to be mindful of, you won't always get an investment valuation report. The value will have to be comfortable, and you'll have to obtain evidence that there are other similar types of properties in close proximity. So if you've got a property in a row of 50 streets and the 49 houses in that street are let to families, and you're looking to get an investment valuation on one of them properties, 9 times out of 10, the valuer will say, we won't be able to give you an investment valuation on that property because the demand in that street will be for a bricks and mortar valuation. Whereas if you've got a property on a street of 30 houses in a university type city, and half of them properties are let to students, we will more than likely get an investment valuation on that type of property, which will enable that valuation figure to be slightly higher. Again, pick up the phone, ask the question. We're more than happy to do a little bit of investigation work before you submit that application to see if you would get that investment valuation. So location is key. As I say, we do investment valuation reports, but we won't necessarily get one in every instance. So pick up the phone, let's have a chat about it, and we'll see what we can do. We also do a red book commercial valuation because we lend on property types where there's 7 or more bedrooms. From a comparable evidence point of view, the value is going to struggle. There isn't going to be many 12-bed HMOs in the close proximity to the subject property. So the value is going to have to conduct a free format report, which is a lot more detail. So if you've had a free format valuation report from a commercial lender, say Shawbrook or Interbay, it'll be pretty similar to that. So there'll be much further commentary on the area. So motorway links, hospitals, universities. So there'll be a lot more information on these red book type valuations than you would from a single self-contained standard valuation. But again, if you have any questions in regards to that, more than happy to help out. So do pick up the phone and have a chat. In regards to limited company, it's still a very popular choice for landlords, especially on purchases. Since the mortgage interest tax relief has changed a few years back, we've seen a lot of portfolio landlords now looking to lend in limited companies. So at Landbay, we're more than happy to lend against an SPV, day one SPV. So that SPV can be set up today. We're more than happy to lend on that tomorrow. We're also happy to lend on LLPs. We don't take any floating charges or debentures. So that's another good point to look when you are looking to place mortgages, that as a lender, we don't take a floating charge or a debenture. So we won't stop that activity of that limited company. We will just take a personal guarantee off the client. We're happy with single or dual representation as well. So again, that keeps the cost down. So if the same solicitor can act for both us and the client is only paying one set of fees. If you're going to a lender that asks that dual representation is needed, your client is going to have to pay both sets of them fees. So although they might be sourcing slightly better than us, the overall cost of that product might not be as competitive. So do bear in mind that when you are looking at limited company applications. SIT codes are required. So the SIT codes would have to be for buying and holding residential properties only. If you know of Landbay, we used to do trading limited companies last year. We don't currently do trading limited companies, but we still are a little bit more flexible than a lot of our competitors. We're more than happy to consider intercompany transactions or holding companies. So what we're seeing at the moment is you might have a client who's got a development company, for example. That development company, the directors are Mr. and Mrs. Smith, and the shareholders are 50-50, Mr. and Mrs. Smith. There's monies retained in that development company because they might have sold a development in the last 6 months. They've been advised by their accountant or broker or tax specialist that monies should be invested into buy-to-let properties going forward. There aren't many lenders out there who are going to lend to Smith's Enterprises because that company wasn't set up for the sole purpose of buying and holding residential property. So a lot of lenders will say you will have to set up a new SPV and you'll have to extract monies from Smith Enterprises and replace it into Smith Property Enterprises. At Landbay, there's a solution which we can help your clients. So your clients can set up a new SPV, which is Smith Property Enterprises. Mr. and Mrs. Smith can be directors of that limited company, but the shareholding can be 100% Smith Enterprises, which is their development company. So that enables the two companies to work closely with each other and move monies from one company to another in a more tax efficient way. So your clients haven't got to extract the monies from Smith Enterprises and then reinvest it into Smith Property Enterprises. So we're seeing a lot more accountants now looking at that structure. And as I would say, it is very much an accountant and tax specialist advice in that way. So if you are speaking to clients, it's always good to have a tax specialist or an accountant working alongside you to make sure it is tax efficient for your clients. And the main option is the same beneficial owners. So Mr. and Mrs. Smith are the same beneficial owners of Smith Enterprises and Smith Property Enterprises. So as long as that's the case, we are more than happy to consider that type of transaction. Day one remortgages, I'd like to say that it isn't a before and after. If it was, it's a very good developer or builder who's managed to do that. But our marketing team have just put from one extreme to the other on this. Here at Landbay, we do consider day one remortgages. So if you are looking or working with clients who are going to auction, who are bridging properties, which potentially aren't habitable or lettable at the moment, we're more than happy to help that client exit that bridge or exit that cash purchase. And we also work at open market valuation within that first 6 months. So potentially you can have a client who's purchased a property which isn't habitable, isn't lettable. You can't place it with a long-term funders. You have to use your own cash or you have to use bridging finance. As soon as the works have completed that property to make it habitable, you can exit that bridge or you can exit that cash purchase with Landbay up to a maximum of 75% on the open market value. So it can be a really quick exercise for your clients to really get their monies back that they've invested into that property. A lot of lenders, as you probably know, will say ownership. We will only look at this type of transaction if it's been owned for 6 months or 12 months, or we'll only look at it against the original purchase price plus cash invested into that property. Whereas at Landbay, we will go to open market valuation if it can be evidence that works have been undertaken to that property. So a lot of my brokers in my region, if they are looking at this type of property and they are looking at a bridge, they'll apply for the bridge at the same time as they're looking at the remortgage on a Landbay product. So they'll get their dip from Landbay, they'll get their dip from their bridging finance, and they can present to the client to say, we've got your in, but we've also got your out at the same time. And at the same time as you're going through the bridging, we're happy to underwrite that application for you, and we'll hold off instructing valuation until a point you tell us that the property is now ready. And it just makes the process so quick, because as soon as you've exited the bridge, you can exit the remortgage with Landbay. So do bear in mind, if you are dealing with clients who are active in the bridging market or the auction market, that there are lenders out there who are willing to exit that bridge straight away. And this just gives you an idea of the order of it. Day one purchase, you undertake the works. We have a new valuation, which is worked on the open market value in 6 months. What I will say, if no works or minor works have been completed, we will have to rely on the lower of the valuation fee. So this doesn't work for your clients who have got an under market value transaction on a property. That would have to wait the 6 or 12 months with us. This only works for the properties which are uninhabitable at the point of purchase. So stress testing, it's also very popular in the market. So we've seen a huge shift from 2-year to 5-year fixed rates in the buy-to-let market. And the reason for that is, obviously, it's a stress testing. The PRA implemented their changes that meant that lenders had to stress at 5.5% on their 2-year fixed rates. Obviously, on the 5-year fixed rates, lenders have got a little bit more discretion. And you're probably seeing now there's a lot of lenders in the 5-year market that are obviously offering their rates at stress test. This just gives you an example of how good Landbay are and how much more you can obtain from a Landbay than some of our mainstream competitors. So this is the 5-year fixed rate, a limited company purchase, and the rental income is £1,000 per month. And the broker was looking for 75%. So if you went to one of our mainstream competitors, who probably source higher than us on a sourcing system because it's very vanilla, they calculate their ICR stressing at 125 at 4.5%. So the maximum loan you could obtain from that maximum lender is 213,333. At Landbay, for the exact same property type, exact same limited company, exact same rental income, we'd actually allow £293,195. So we're actually obtaining a lot more monies out of that product for us. So again, specialist lenders might not be top of the sourcing systems when you are sourcing mortgages, but we are there to help your clients when you need to. So do bear us in mind when you are looking to get the maximum out of your properties. 5-year fixed rates work very well for London and the South East. Obviously, property prices have risen quite highly over the last kind of 5 to 10 years. Rental probably hasn't kept up to the same speed. So you do have to look at the pay rates for this type of properties. Sorry, guys, nearly finished. I think I might be running over. Just some hot topics to finish. Landlord payment holidays. Tony mentioned it earlier. UK Finance has suggested that 1 in 9 landlords have requested a payment holiday. There's a lot of different lenders offer different criteria points onto this. At Landbay, we'll consider them on their own case merits. We would insist that there aren't any payment holidays at point of application, but we wouldn't decline an application because the landlord has taken a payment holiday. We'd like to understand the reasons why the landlord has taken that payment holiday. If the tenant has been put on furlough or has been made redundant, then the landlord is in his own right to really take that payment holiday at that point. So we wouldn't punish them for that. So here at Landbay, we're more than happy to consider as long as the payment holiday has finished and there's a good explanation behind it. Valuations, we've seen a lot of lenders pull away from student lets over the last few months, mainly because probably we didn't know what was going to happen with the students going back to campus, obviously with the lockdown. Throughout the pandemic, we have lent to student lets and we will continue to lend to student lets. Universities are back, they're back on campus. There's a lot of people, as we know, where they like to go to campus and they like to go to university. So as a lender, we're still open for business on student lets. Bounce back loans, hot topic in the market. We're getting a lot more inquiries now from brokers saying, I've got a client who's taken a bounce back loan and they want to use that for the deposit and the next purchase. We won't accept it. It's a big no-no for us. That wasn't the purpose of the bounce back loan in our eyes. So if your clients are looking to use the bounce back loans for the deposits, it can't be with Landbay, unfortunately. If they can evidence that they had other funds in their bank account, yes, let's have a look at that. Let's have a chat. We're more than happy to consider that. But if solely you're looking to use a bounce back loan, that wouldn't be acceptable to us. As Tony said, we reduced some of our rates on Tuesday of this week. So at 60 and 70% loan to value, we will be top of the tree when it comes to sourcing. We'll be very close to Paragon on the sourcing systems. So on our 2-year and 5-year rates, 60 and 70%, we've got some unbelievable rates which are sourcing very, very well. So if you are sourcing them type of LTVs, you'll see Landbay top of the tree. So again, if you have any questions or you'd like to have any more information, please do give me a call. And just the conclusion, buy-to-let market is evolving and who's are adapting and thriving. So it's kind of saying, jump out your comfort zone. If you've very much dealt with vanilla type buy-to-let landlords in the past, there is a growing sector on the specialist buy-to-let market. So if you haven't been in that sector, do get into it. There is a lot to learn there, but there's a lot of business coming on the specialist market. So if we all adapt, we will all thrive. And that's all from me. Thank you.
Okay, thank you, Rob. Hopefully everyone can hear me. Got a couple of questions already, I believe. Sandeep, we can't go back to the slide because we're running slightly over time, but the entire presentations will be available, and I'll explain a little bit later where you can find them. So one of the questions we got, hi Rob, UTV. Okay, we met before, Rob Smith in Plymouth. I have a case turned down. I've had a case turned down because my client's bounce back loan was more than 25% of turnover. What would you guys say?
As I say, really, in regards to the bounce back loans, we don't assess the application just purely on that bounce back loan. If your client can evidence that they had monies in their bank accounts to pay for the deposit, I'm assuming it's for an onward going purchase. So as long as your client can evidence to Landbay that they had the deposit sitting in a bank account before that bounce back loan was taken, we would consider that application. So more than happy to take that offline and have a call with you at any point to kind of understand where that application is going and why it's been declined for another lender, really. So as I say, we will look at it in its own merits. And obviously if the applicant can confirm that there was monies in that bank account before the bounce back loans, we would be more than happy to consider that moving forward.
All right, fine. From my view, I'd probably say the client should maybe speak to the lender and say they made a mistake. Because if they're taking more than 25% and they've broken the terms of the bounce back loan scheme, and potentially could be in not serious trouble because it was only a couple of grand, but if they've actually taken 50% of their turnover, then I would imagine that that will be flagged. potentially in the future. Paul Sack has said, tracker no ERC product for limited company or individual buy-to-let.
All products. We've got no ERC tracker rates for our individuals, our limited companies. So yeah, if you've got clients in a limited company or in their sole name, our no ERC products cater for all.
Okay. Of course, all the products are in the product guide, Landbay product guide that we sent you by post, but also on the email this morning. So just take a look at that. Just a little bit. Rob, you're not aware of this slide because again, I did this late last night. If you have any Landbay documentation needs, just go to lenders.specialisthub.co.uk/Landbay. That is also on the product guide that we sent to you. And it's got all the forms you need, decision in principle forms, application forms, tariff of charges, lots more. And we do ensure these are kept up to date. We do look at the lenders' websites on a very regular basis to make sure we've got the current stuff, because we want everybody out there to maybe be using our site to access lender documentation. Because we'll just make sure, and of course we'll also try and make sure that all the forms are editable, because a lot of lenders have PDFs that aren't editable. You need to discuss a case. We've got a 0800 number specially designed for Landbay. So when it rings here, it goes through to the Landbay team and they will know it's regarding a Landbay case. Rob, thank you very much. We are a bit behind time, so I'm going to
Brilliant.
Thank you very much, and look forward to the next time. And we'll now just put on the next introduction. Bear with me 1 second. This is the introduction for Castle Trust and for Mark Stephenson. And there's a picture of him. There you go. And it'll appear in a moment. So you should see the beard in a moment. So here it comes. All delegates, you should be looking for that in the information we've sent you. If you can see that, it's just a one-page document. Castle Trust have recently come back to the market with what I think is a fantastic product. It's one of those ones that is pretty much, it's not quite unique, but it's pretty close to being unique. So a little bit on Mark, and I'm going to rush through this. And Mark, we are a bit behind time. So if, when we come to your slides, obviously,
short and sweet.
Thank you. So Mark's been working for Castle Trust 4 years as BDM of the East Anglia region. Mark and I have met once just prior to lockdown. Very impressed by him. And we've spoken a couple of times since, but we met in February and that was it. And I did say to the staff, this guy is good. I'm not just saying that because he's on there. This guy is good, by the way. So he looks after all areas of property, lending within Castle Trust, bridging complex buy-to-let mortgages. He can now provide instant terms on mortgages up to the value of 500,000 and helps brokers structure more complex deals too, so as to present cases in their best light for a positive outcome. His interesting fact, he became a dad at the start of lockdown. Congratulations, Mark.
Thank you.
Boy or girl?
A girl, Callie.
Yeah. Congratulations.
Thank you.
I've got one daughter as well. Cost a fortune, by the way. Got all that to look forward to. Just wait till they get married. Oh my God. Anyway, okay. So I'll just now put on your presentation, and then we will be good to go. So if you still bear with me 1 second. Okay, Mark, over to you.
Thank you very much. Well, Tony, thanks first of all for having me present and the help from Kylie and Hayley in getting this set up. No thanks at all for this having to be the first time I'm wearing a collared shirt in 6 months, because I am very much feeling the pinch. You can probably see the buttons popping through because of the lockdown podge that I've put on. But as Tony said, Castle Trust are very much back in the lending space. We weren't looking at any new inquiries at the start of lockdown, although we continue to talk to our partners about deals and what we can do. But one of the big things that happened during lockdown is that Castle Trust became Britain's newest bank. So in June, we received our full banking license. And of course, that presents us with lots of opportunities, lower rates, which I'll come on to shortly, more streamlined processes, and being able to service a lot more customers and introducers with the products that we have. So there's a little bit of information here about Castle Trust, who we were. A lot of people might have had touch points with Castle Trust when we started off initially as a quirky second charge buy-to-let lender. More recently, people have seen us as the lender for the bigger ticket deals, multi-unit blocks, development finance, etc. But now we want to take forward the appreciation we have for the more complex cases, but in being able to treat them in a little bit more of a mainstream fashion by being able to offer now 2, 3, and 5 year fixes. as well as still providing bridging finance, development exit, and also being able to do the more complex deals that people have known us for. We are intermediary only lender. So, our main client are you, the brokers. So we want to provide you with all the information that we can. And the way that we treat it is I really want to be able to talk deals through with you, because they're not the kind of inquiries that can just be put onto a sourcing system, put through a sourcing system, come top of the tree and submit the case, because they are a little bit more complex, be that with the client type, the property type, or value of loan. So that's a little bit about who we are. Now, who do we want to lend to? Of course, we can lend to UK residents, but we also accept foreign nationals and expat clients, and we can lend to clients who are based anywhere in the world. So there are no restrictions on the country that the client can be from or living in, depending on where they are, where they're from, and what is perceived to be how risky that country is as a domicile or place of origination will determine the product that the client can have. But the key thing is that there are no restrictions on any countries that we can lend to clients. We also lend to SPVs, limited companies, and those limited companies can also be based offshore. So as well as the likes of Guernsey, Jersey, Isle of Man, we can also look at the Caribbean islands. We've seen Cypriot limited companies, and often, companies that are based in tax havens. We can also lend to LLPs and trading businesses as well. We're used to dealing with complex structures of companies, be that with umbrella companies and holding companies with many different shareholders. We've been used to dealing with those all the time, and our underwriters have got the skill to be able to sort of unpick those more complex structures for us to determine that it is a case that we can do. What's also unique about Castle Trust is that we could also use any number of these complexities within a single case. So you might have a foreign national who is now an expatriate in another country, and they may own a property that is held within a newly formed limited company. There are many competitors out there that one of those points may throw it out. So you may have a lender that says, oh, I can deal with expats and limited companies, but it has to be a British expat. Or we can deal with a foreign national who's buying a HMO, but not if there's a limited company involved. So when there are a number of complexities on the case, that's really when we should be your first port of call, because we can say yes to more deals. So those are who we can lend to. Now, what can we lend on? So everything that we do is focused on residential buy-to-let properties. So we don't do any commercial units, so no shops, warehouses, etc. We don't do semi-commercial, but we do flats above commercial, for example. So essentially, it's a property in which somebody could live. So within that, we have HMOs, and we have no limit on the amount of bedrooms within a HMO. Holiday lets, which seems to be extremely popular at the moment. Now, with holiday lets, they need to be a property that doesn't have any restriction that it can only be a holiday let. And the same goes for serviced accommodation. Vacant investment properties, again, very popular with the bridging side of what we do. Client might be looking to buy a property that is slightly run down. There's no tenant in. They simply want to go in, give it a lick of paint, slight refurb, and then either sell or refinance. And multiple properties on a single title. Popular with developers, so we might be looking at a block of flats. There's no restriction on how many flats within that block. We're happy to look at very large portfolios and blocks, but also you may have a developer who has 4 houses that are to remain on one freehold title, which again, we are fine with as well. So just a bit about holiday lets, as they seem to be really popular at the moment. I mentioned that we can't have any restriction on the holiday let, which is often the case with properties that are on holiday parks or areas in which they're trying to restrict people who aren't locals. But effectively, if it is if it could be a normal residential property or a normal buy-to-let, but the client wants to use it as holiday let because of the benefits of increased income that they can earn, then that's a property that we can lend on. Again, same for serviced accommodation, and we do accept Airbnb as well. I'm sure there's lots of you have had inquiries for holiday lets because, as I said, it seems to be the hot ticket at the moment. Landlords looking to expand their portfolio, with a lot of people holidaying in the UK now as well. It just seems to be really popular at the moment. So I'm going to just discuss our products with you now. So we've got 3 distinct verticals that we're lending across. And I'll go through them in chronological order of how long the product lasts for. So bridge to let, of course, our shortest term product. This is a 9-month bridge. And currently, as we are coming through COVID and there's a little bit of uncertainty about what might happen at the back end, our bridge product is actually linked to our term 10 mortgage. So this is a bridge to let in, as the name would suggest, we will bridge the property first of all, and we provide a guaranteed exit for the client. So I'll come on to the term 10 shortly, and link those two together. And then we also have the complex buy to let. Now, where many lenders may consider complex buy to let, that's our standard criteria. What we would consider complex would be very high risk foreign nationals, large HMOs, and the like. But things like limited company, expats, normal size, so up to 6-bed HMOs would all be considered standard criteria for us. So we've got a slightly more open net on what we would consider to be a complex deal. So product specifics on the bridge to let. As I said, we arrange a pre-agreed exit from our bridge onto our term 10 product. Now, the massive benefit that gives us and you at the moment, and especially for the client, is the surety of the exit. When we're writing a bridging loan at the moment, we don't know what might happen in 9 months' time, if there's another lockdown, if there's going to be restrictions on valuers being able to go out to see properties, if estate agents aren't able to show people around properties for them to be sold. We don't want your client to be sat on a property that they can't do anything with and be stuck, a potential mortgage prisoner, and maybe have to give up the keys. So what we have done to prevent that is we will provide you, at the time of providing you with the bridge terms, is a guaranteed exit. So we know that if in 9 months' time the client hasn't been able to exit the bridge, we can say you can put the tenant in. We know what the rental is. We've assessed that at the very start, and it means that you can move on to a 5-year fixed product with us, and without any worry of having to lose the property or be under too much pressure to sell. Specifics about the bridge itself: it's a 9-month term. The interest is all rolled up, so there's nothing to pay for the 9 months, and the rates are starting from 0.67 per month. Generally, it will be 0.67, maybe a slightly more if it's an unmortgageable property and there's a little bit more work to do, but in most cases 0.67 is where the rate will be. We'll lend between 50,000 and 2 million, and the maximum asset value is £4 million on this product. Minimum asset value would be 75,000. We do allow refurbishment for the property, as long as that refurbishment doesn't require any planning. So provided that all of the works fit under permitted development. So in many local authorities, that would include a loft conversion or a small single-story rear extension. But as soon as the client needs to or has gained planning to do any refurb for that property, that's not one for us. It's very much light refurbishment. So as I mentioned, the bridge to let feeds directly into our newest product, which is our term 10. So this is the most mainstream product that Castle Trust has ever had. So it's called term 10 because it is a term loan for 10 years. So it's not a 25-year mortgage, it's a 10-year mortgage, but we come with a fixed rate of 2, 3 or 5 years. The maximum loan amount is 10 million, more by exception, and the maximum loan value of 75%, and it is an interest only product. So as I said, this is the most the most mainstream product that Castle Trust have ever released. Rates start at 4.19% and range up to 5.29, depending on the complexity within the case. Now, the real strength that we have with this product at the moment, and especially between ourselves and specialist lending, is that any deal that they send to me up to the value of £500,000 on the term product, we can get pricing instantly for it. Previously, we had to send it through to get official terms, but up to £500,000, we can provide instant terms. And that does include the niches, including limited companies, first-time landlords, HMOs, holiday lets, expats, and foreign nationals. So again, what we consider to be our standard criteria, a lot of lenders might call that complex, but not for us. As I said, we can say yes to a lot more of your inquiries. Finally, what we would consider our complex buy-to-let, and this is complex in a case of property client, but also the structure of the deal. So our complex buy-to-let range is from 2 to 3 years as the term of the loan, and you can have a varied ERC period within that between 2 and 5 years. So we could provide your client with a loan for 5 years, but only a 2-year ERC to provide them maximum flexibility. That sort of thing works really well on high value properties where they want to sell, and it may be a property that's going to take a long time to sell, but we can vary the ERC to give them that flexibility. The rates start from 5.29%, and loans range again from 50,000 to 10 million and above. Now, what we would consider complex to fit within this product and what wouldn't fit on our term 10 would be HMO properties over 6 bedrooms and high risk foreign nationals where they are from and remain or live in another high risk country. The other way that we can use the complex buy-to-let product is that we can provide a combination of serviced and rolled up interest. So some of you may have used Castle Trust before as for a second charge. Well, what we're able to do, and it's a useful way of being able to find an alternative to top slicing for low yielding properties, is that we can provide a serviced interest only mortgage for as much as the rental will allow, but then we are able to top that up with some rolled up interest on top. So for example, if you had a low yielding high value property where the rental income was only able to raise 50% loan to value because the yield was poor, we actually have the ability to tag on up to an extra 25% on top of that rolled up, because the rolled up part doesn't have to be stressed. Now, we need to make sure that there are strong exits for that, but it is a very, very useful technique and a product to be used for higher value property. Although, certainly in central London where the yield is never going to be enough to get you to 75%. Generally across all products, we go up to 75%. And this product or structure allows that to happen even for lower yielding property. This slide, it breaks down basically what I just mentioned about the combination of the roll up and the serviced interest. And that was short and sweet from me, but I welcome any questions at all. I can see that some have come in down here. Tony, do you want to curate the questions?
I'll read them to you just in case.
Yeah, sure.
Can't see. So Harry Sandu said, what is the maximum loan to value on the bridge to let product?
And that is 75%. So we roll up to 75%. So if you want to cheat and do a real quick calculation about how much we can lend to your client, what they will get in their pocket is about 69% because we roll up to 75.
Okay. And a couple of questions we prepared earlier for you.
Mm-hmm.
Do you still do second charges?
They're not the flavour of the month at the moment, just while we're coming through COVID, but we will consider some second charges. They would need to be for a minimum of 200,000. So we would really be looking on larger portfolios or higher value property. We can also still provide second charges on residential owner occupied property, but the client must be a high net worth individual.
Excellent. We have just a deal for you.
Sorry, when?
Today.
Sorry, say that.
Go on, carry on. Go on, carry on.
So we had a very popular product before, which was the second charge on residential for business purposes, but unfortunately, that's not something that we're providing any longer.
Okay. Last question I've got for you is, what lending don't you do? That could be a long answer.
It's pretty straightforward, actually. We don't lend on commercial, and we don't lend to clients with too much adverse. If it's a residential investment property, I can probably say yes to the deal. So no commercial and no severe adverse.
Okay, right. I haven't got any more questions. If anyone's got anything to ask, then there's still probably a minute or so to ask it. So they're just, as per the previous speaker, for all your Castle Trust documentation needs, just go onto our website. We've actually shortened it down to CTB because they're now a bank. So,
Yes.
so that has everything in there: quotation request forms, data capture form, lots more. Basically, everything that's on their website, we put on our website, and we'll regularly make sure that their website is up to date. If you have any cases to discuss, again, we've got an 0800 number that goes through to the correct team. So, and of course, you can email us ctb@specialisthub.co.uk. And there was one other slide you've got, Mark, which is the Castle Trust disclaimer, because you're now a bank. So obviously you've got to have this sort of stuff. So I expect everyone to read this next slide, and then because you may be tested on it at the end. In fact, it's so boring, it won't even come up. There you go. So everybody,
It's there. Yeah.
If you read that, good luck.
What I would say, Tony, is that a lot of the conversations that I have start with, Mark, I don't know if you can do this deal, but, and it usually takes the broker to get a long way down the list of complexities on a deal before it's something that we can't actually do. So even if it's looking too complex, or there are a number of things that are proving difficult with other lenders, give us a call first of all, because as I said, we can probably say yes quicker.
Okay, and as a company, we as a company, Specialist Finance, have got packager status with Castle Trust, and we've found them to be absolutely fantastic so far. We really have. Rob Smith just asked, I've got a very quick one. So what are service turnaround times like?
So if you're looking for terms up to £500,000, I can give them for you instantly. So I would say anything that comes through from specialist lending, I try to get out within 4 hours. Anything higher than that to get priced up to 48 hours. And then from application to funds being released between 6 and 8 weeks.
Yeah, one other thing I'd say, I do have a very, very good online system. It's one of the best that I've come across. Very simple for us to use, and is updated, which is the main thing. And when something changes, it does actually tell you, which is good. And there's asked one last question before we go. Drive-by valuations?
No, we're only providing drive-by valuations for any refinance cases that we're doing at the moment. For us, because we have so many variations in the types of clients and structures that we can lend to, the property is the most important thing for us. So we do need to have a physical valuation.
If we're going to lockdown stage 5 and surveyors can't go out again,
then we will make plans to be able to work around that. Yeah.
That's your plan F, right? Okay.
Indeed.
So, Mark, thank you very much indeed.
Thank you, Tony.
There are a couple of people typing, but I will probably just allow these to come through just purely because we could just cut down the break by. We'd still come back at 11:30. There's a couple of people typing. Can you use Allied Surveyors valuation? Robert Smith's asked.
No, they are not on our panel. We currently would use the Red Book valuer, so Knight Frank, Savills, etc., for higher value properties, blocks of flats or portfolios. For standard properties, we'd be using Connells, and we are soon to be taking on a VAS panel as well. Okay.
I must admit, we only use Allied Surveyors either when A, we have to, or B, when we want to get something down valued on the client's behalf, because you'd maybe looking to purchase the property, because they always knock 10 to 15% off anyway. So
right.
They're certainly not in my top 5 surveyors, I must admit. Dinesh has said some tenants are nervous about letting people in for valuations, but that's, we're all aware of that. We've already encountered that as well. So we tend to be overcome in some way. So, okay, Mark, thank you very much. Great presentation.
No problem. Thank you.
So everybody, we're just going to break for 10 minutes. It's now 11:20. We'll break 10 minutes and back at 11:30. Okay, welcome back, everyone. We're just trying to get Kerry, our next presenter, live on the system. So I'll go through her introduction very slowly, if I may. Just starting with, you need to be looking out for the documentation that we've sent you. Here she comes, good. So we sent you 2 bits of paper, the residential second charge loans and also residential mortgages. They've gone in the post and also on the by email this morning. Okay, Kerry's just appeared. Kerry, can you hear us?
Yes, I can. Can you hear me?
Kerry? No?
Can you hear me?
Oh, you can. Yeah, you're a little bit quiet, just so you're aware, but that might just be here.
Is that any better? I'm just turning my volume
I
up.
can see a banner with a big black bit behind you saying, "We understand," which is good. That's much better. That's brilliant. Yeah.
Perfect.
Great, thank you. Okay, so a little bit back, Kerry, first of all. When this decides to load up. Apologies, everyone. We have had some internet issues today. Really not sure what's going on. We pay a fortune for our broadband as well. Okay, as an experienced BDM working at UTB for 2 years, Kerry's role is to work with specialist mortgage brokers. Her area is South, and she can help brokers by providing residential mortgages and second charge loans for a wide range of purposes, from purchasing property, remortgaging, or to raise capital from their property for a variety of purposes. She really enjoys spending time with her 7-year-old son. You just wait until he's 15, socialising with family and friends. And she has a new puppy called Maybell, which is keeping all the family busy. A good night in. I read this last night. I thought you and my wife must be long lost sisters or something, because watching a crime drama, my wife thinks she's a detective, or one of the Real Housewives shows, which my wife tapes, uses up all the memory, which is a guilty pleasure, with a G&T or a glass of Prosecco.
Or both, depending on the day of the week it is.
Could be called Louise, honestly, you really could. And her interesting fact, when it decides to appear, is Kerry is a keen Spurs fan. We've got 2 of them today, by the way. And as a teenager, played for Haringey Girls 5-a-side team. So there you go. Okay, so I'll just put Kerry's next presentation on. Kerry, then it's all over to you. We're running on time, so all looking good.
Perfect. Thank you. I'm assuming everyone can hear me okay. Hello, everybody. Thank you so much, everybody, for attending today, and obviously Tony and the team at SFS for having me here today. I just wanted to obviously talk to you today and not bore you too much, hopefully, regarding a little bit about United Trust Bank, who we are, where we've come from, and get a feel for obviously what we can offer out there within the specialist lending world. So I'm just going to start off by obviously talking just very briefly about myself, because I'm sure you don't want to hear too much about me. I've been within the specialist lending market now for 21 years, dare I say, covering quite a wide variety of lenders out there, from buy-to-let, unregulated bridging, commercial lending, development finance, first and second charge mortgages. Back in the day, I used to work for Mortgage Express, and as you can imagine, sort of low self-cert, non-status, very specialist lending back in the day. I've now been at UTB now for 2 years, and within that role, I look after the southern region for the bank, covering first and second charge mortgages. Now, I'm just going to move on slightly just to a little bit about background about United Trust Bank, in case you're not aware of who we are and what we do. Now, we actually celebrate 65 years this year of trading. We first started within the industry in 1955, and our product range started with development finance and retail deposits back in the 50s. So it's quite a long legacy and history there. The ethos of the bank is to have a full life cycle of lending. So I suppose how we see ourselves is a long-time lender and a lifetime lender. So we weather all the storms, shall we say. We weather all the market changes. We weather all the recessions, and we always come out in the end with some kind of diverse product range. Back in 2010, we launched our bridging finance sector, and then evolved into asset finance, following into 2015 with second charge mortgages. Now, second charge mortgages for us is one of our biggest areas within new lending for the bank, and our market share over the last 6 months has more than doubled in regards to where we sit and the propositions that we have. Only last year, back in 2019, we actually launched our first charge product range, and again, like our second charge product range, has evolved greatly. So now we have quite a large, diverse product set within the first charge lending. So, for example, we do purchase, remortgage, unencumbered, and 2 weeks ago we launched an interest-only product within that range as well, so which we're very excited about. 2020, or who was to expect where we would be in 2020, or where we would all be? I think the key message that we pride ourselves on at United Trust Bank is that we are here to help you grow your business as well as ours. And one of the key things that we've been able to do throughout this summer especially is launch our Broker Summer campaign. And I'm sure you would have seen it through all the trade press and through LinkedIn, that we've been launching these weekly packages, support campaign packages, to help you with another level of introduced business. So, for example, one of the things that we did was interest only launching. One of the other things that we did was reintroduced overtime payments. One of the other things that we've also launched was digital Nevo, electronic identification checks for clients. So again, eliminating some of the hurdles that some of you may have faced throughout the pandemic. One of the areas that I'd like to talk about is obviously where we sit, and from your perspective is obviously who we are and where we sit from a lending perspective. Now, as a specialist bank, we are able to offer things outside what the standard high street lenders can offer. So, for example, we see ourselves as a tier 2 specialist bank. So we sit comfortably behind the challenger banks, or sometimes at the moment alongside the challenger banks out there. So we're able to offer more niche and more niche product offerings. And again, not many people are aware of what we can actually do. So I'm going to now talk through sort of the 3 key areas of us of lending, which is people, sort of placement, products. So the next section I'm moving on to is people. Who do we lend to? So the key thing is we lend to employed, self-employed contractors and those that may have additional income. So, for example, employed, we will accept clients that are on 0 contract hours, bank workers. We will accept people that have second jobs or multiple jobs. Our system and our application process allows for customers to actually have up to 6 levels of income streams. So again, from a diversification perspective, we can allow multiple income streams as long as it can be evidenced. And that's the key thing for us. This is what makes us specialists with our underwriting profile, is that we're able to look at things outside the box. We don't have an automated system that makes a decision for you. We make the decision. We look at cases individually and they're on their own merits. We now accept overtime and bonuses as long as the clients can prove a continuous overtime history and a commission earning history. At the moment, we're looking for 18 months. But again, if you have a scenario where there's been a small gap with a plausible explanation, this is something we can certainly consider on referral for you. Minimum time in job. Now, again, this is slightly unique for a bank, is that we ask that employed clients are in their current role for 3 months, not in probation, but have a 12-month track record of employment behind them. If they don't have a 12-month track record behind them, we will accept them in their current role for a minimum of 6 months. So again, it can work in either scenario for you. With self-employed, we would accept sole traders, limited company and partnerships. With sole traders, we can use their net profit as a source of income, and they need to have been trading for 2 years, and 2 years worth of SA 302s as evidence would be needed. With regards to limited companies, we would take salary and dividends, or a combination of one of each would be acceptable to us as a source of income. Unfortunately, we don't take net profits from limited company directors as a source of income. But again, we do find a lot of people may have 2 or 3 limited companies. And again, as long as we can get accountant certificates for each of those limited companies to verify salaries and dividends drawn, we can use all of that as a source of income. Again, like sole traders, we require that they are trading for 2 years. And again, 2 years worth of accounts or accountant certificates alongside taxation submissions through HMRC or tax overviews. And again, for everyone that is a sole trader, we will allow for all of the product range available to them. So they're not restricted on what they can have. Now, our current level of borrowing is up to 75%, both on first and second charge mortgages. Moving on to contractors. Now, we launched contractors as part of one of our summer campaign enhancements to the product ranges. So this is quite new to us. I think it's been running for about 6 weeks now. So we will accept contractors that have been trading with accounts for at least 1 year. We will accept the day rate over a period of 48 weeks. And we will accept contractors that may be under umbrella companies or through limited companies as well. I can provide further information regarding the contractor policy, but it's proving very popular, as you can imagine. And the key thing for us here, as long as they've got a 24-month history within that same field that they're contracting, we can consider them for lending. And finally, just moving on to additional income sources. So we will accept state or private pension as a source of income. We can accept benefits as a source of income, but we are restricted on the types of benefits that we can use. So, for example, we can use working tax credits, family tax credits, and child benefit, but we can't use disability allowances or carers allowances. But again, if you're not quite sure, just pick up the phone, give me a call, or give SFS a call. And again, we do lending into retirement. And one of the key areas for us is that we can lend from the age of 18 to 85. So we do a lot of older client lending, whether it be for short term or longer term. So we can lend up to the age of 85, as long as income is plausible and sustainable through lending into retirement. We stop using a employed income status from the age of 70. So just moving on now to my favourite area. So property types. Now, and you say is, okay, so why are we using UTB? Now, this is I think one of our best kept secrets. Now, unlike some other lenders, we won't restrict your loan to value based on the property type. We have three main categories that have to survive. So one, if it's a leasehold property, there's a minimum of 60 years remaining on the lease, and the property must be mortgageable. Second of all, is the property traditional to area? And third of all, is it habitable? So when we say unusual property types, I'm not talking about a grade 2 listed building, which we can do, but I'm talking about, which is quite more common than anything else, it's flats above commercial, flats above retail, restaurants, takeaways. We will lend on those assets, i.e. we will lend on the flats above or the masonettes above. If they are adjacent to or the same road as, again, some high street lenders don't have the appetite to lend on that type of security. However, we do. We will also lend on non-standard construction types. So precast concrete, timber frames on single skin. Again, as I've mentioned earlier, grade 2 listed buildings. Purpose-built flats that may have commercial elements underneath them. I'm pleased to say that this week we've agreed to do a second charge on the 18th floor of a 40-storey block in East London where it's commercial underneath. So again, let us know what you have and let us know what we can do for you. We have done semi-commercial lending on residential basis, both on first and second charges, where a client may have one less than 25% of their property is for home working, or they've created a small shop or a studio of some kind, or potentially a hairdresser's or little beauty salon, or even one we've had this week where they would become a chiropractor and converted their garage into a little clinic. Let us know what it is and we can see what we can do. So again, it's not just about obviously who we can lend to, it's about what we can lend on as well, which makes it a massive opportunity for you. And the good news is we won't restrict the loan to value. So for example, you may have an ex-local authority flat above a Chinese takeaway with shared balcony access, for example, where it's on a massive stream on a street. If you do have one of those, we can lend up to 75% on a first and second charge basis. So again, a massive opportunity there for product placement. Moving on to our products. Now, this is there's certain areas in here, so I'm just going to go through them one at a time. USPs, obviously, I've just mentioned our property types is probably the top USP for me anyway. But our second USP is the way that we profile our clients. So, for example, we don't work on a credit score. And we have recently adjusted some of our lending criteria on our second charges. Now, what we've done is if you have somebody, for example, that has 5 credit cards and they're currently showing 4 missed payments down up until today, and they're doing a refinance to debt consolidate this debt and start afresh, we will ignore those 4 missed payments down and put them onto a status 1 plan. So our status 0 plans are for prime. Status 2 plans are for the near prime in our eyes, and then status 2 is for clients slightly more adverse than the status 1s. Now we do have quite, I'm sure you would have seen in the product guides that you were sent, the status profiling and how it works both for first and seconds. So a status 0 customer to us, again, unlike the high street, we're a bit more flexible on what we view as adverse credit. So a status 1 client to us, so a status 0 client to us is somebody that has all their unsecured payments up to date. Now, we mean up to date, i.e. in July, they may have been showing 2 or 3 payments down on a credit card. If they've brought that back up to 0, and we can see it's brought up to 0, or they can evidence from the creditor, because the credit file hasn't been updated, it's now back to 0 and they're up to date, and there's no other adverse in the background, we will treat them as prime. In addition to that, if they do have not up to date, as I've mentioned, based on our second charge lending, we can look at clients potentially that have currently arrears within the last month, but they're doing a refinance to debt consolidate those. So again, how we profile is very flexible in how we offer the product ranges. Moving on to obviously product range, we have quite a varied offering of products ranging within the 65, 70, 75% tiers. Our products start at 3.85 and 3.95, depending on the LTV and the product sets. We offer with or without ERC products as well, so there's flexibility there. So we have 2, 3 and 5 year fixed with ERCs, and then we offer tracker rates with no ERCs, and we offer 5 year fixed with ERCs. So again, the flexibility is there for you. Loan purpose. Now again, this is another USP, is we don't cap the LTV for debt consolidations or home improvements. What we do say, it has to make sense and be plausible to the rationale. So again, there's flexibility around that. We do a lot of HMRC tax bill lending, so tax bill is not a problem, and again we don't have a restriction on the monetary amount, as long as it fits within our tierings, obviously, in regards to that. In fact, we've done one recently where it was £140,000 on a second charge for a tax bill. So again, there's a lot of flexibility there. Clients that are going through a divorce or separation, again, we can assist with those, whether it's transfers of equity, transfers of title. We also lend for onward purchases of buy-to-lets, holiday homes, buying abroad. Again, we've done those recently. We just agreed yesterday to do a property purchase over in Italy. And again, pretty much any legal purpose. So again, the flexibility of why, and as long as it makes plausible sense to us and there's evidence to support it, we're more than happy to support. So as a bit of a summary, so sorry if I've all talked at you for the last 10 minutes, is flexibility, underwriting flexibility. The products vary quite rapidly. The profiles of our customers are very varied. The key thing for me to you today is give us a call. Let us know what it is that you need, and let's see if we can assist you. Again, we are, yes, so thank you very much for your time, and I'll hand you back over to Tony.
Okay, thank you, Kerry. I've added one slide into yours. So again, as before with the previous two speakers, any documentation needs you have, go to lenders.specialisthub.co.uk/UTB. Got literally everything in there that is possible. If you need to discuss a case, then give us a call on the number 830 0800 830 3046. And again, this is on your documentation we sent you in the post and by email, just so you're aware. Again, everything is there that you need, but my staff are ready to take calls. And we've been using UTB Syntor for many, many years. But we've been using them on the second charge side, especially the first charge side when it was launched. They've got a great bridging product as well, one of the cheapest in the marketplace, especially on regulated bridging, just so you're aware. And just a great lender to have on board, really. And we're very lucky as well in that I know all the hierarchy. The managing director, Robert Owen, I've known for 35 odd years, will consider him to be a friend, more than like a business colleague these days. We've just known each other for so long. So we'll just go on to the questions. Okay, if anyone's got any questions, I've got a couple of, I think I've got 4 actually, that are preset questions. So there you go. There's a little emoji of Kerry. So
I just wish I looked that slim. Hasn't been that kind to me in lockdown.
Yeah. I can only see your head, Kerry, unfortunately. So do you charge any upfront fees?
We don't, no. So all fees are added. So the only upfront fees is what's chargeable from the advice perspective, but all fees are added. So we do have application fees, also on the bridging side. We have product fees, which are all added upon completion. So there are no upfront fees to clients.
The second question is, can you explain further all the property types you can consider? Might be quicker if you just say the ones you can't, I suppose.
Land on first and second charge, waste sites, brownfields, pretty much, real commercial entities. We're not a commercial term lender. So again, the property types can vary. And again, if you're not sure of what we can do, send us a copy of our report. Send us a link to the property. We're more than happy to have a look at it for you. It's quite varied, so the list can be endless sometimes. But the key thing for us is flats above shops, non-standard construction, and high rise.
Okay, third question. How do you view payment holidays in the current climate?
Favourably. I think the key word there is, so for example, if clients have taken unsecured or secured payment holidays, we just need to see evidence they are out of the payment holiday and they've made their first payment into what we call the norm for them. So as long as they can evidence they're out of it, we will treat it as a normal payment structure. So for example, I know that unfortunately, some people's credit profiles have been affected by this. Now, as long as we know at the time frame, if we're looking, say, at an Equifax report and June, July and August are showing as a payment down, however, within that time frame, we can see evidence from that said lender that they're in a payment holiday and they're now out of it, we will disregard the record showing on that Equifax report.
Final question I've got, no one's typing anything. So can you advise how clients can qualify for automated valuations for your mortgages?
Absolutely. So I'll start with second charges. So any loan size up to 100,000 within up to our 65% tiering will automatically qualify for an AVM as long as the security is up to £1 million. And then on our remortgages, any up to 250,000 borrowing up to 75% loan to value. So there's some flexibility there around the AVM process. As long as on a remortgage basis, there has been a valuation done within a 5-year period, we'll accept it on an AVM as long as the AVM comes in at a confidence level of 5 or above. And that's both first and seconds.
Who do you use for your AVMs, just to confirm?
So it's Home Track and our valuation panel is Pure. So the good news is even now, we've certain clients are still experiencing difficulty getting valuers out, and throughout the pandemic, we've been able to get valuers out over this period. We've been able to support where clients have gone to other lenders and those cases haven't proceeded. We've been able to take those existing valuations and go with retypes. Even some on occasion where the valuer isn't on our panel. So we've been trying to really help utilize what we can do to help people.
Okay, I've really got to say, Kerry, I mean, UTB really have been one of the star performers as far as lenders are concerned over lockdown, because where others sort of like basically just either dropped every product they had pretty much and had all their staff fielding phone calls for payment holidays, you guys really did. Paul, you did absolutely fantastic for us and many others that I've spoken to as well. So. Yeah, if I could give a virtual round, get everyone to give a virtual round of applause, I would do. But no, you as a lender, absolutely superb. So, say we've got a great relationship with UTB. Got quite a lot of second charge stuff going through, especially at this moment in time, where others have withdrawn from the market. And there's been one I mentioned before, one withdrawal just in the last week, by increasing their credit score to a level where no deal will get through. Whereas UTB really have been there throughout. So. Okay, we've got no questions. I've got Jim Nash has said up the Spurs and clap flat.
Thank you.
He's our next speaker. So you must have covered everything, Kerry. So thank you very much indeed.
Thank you, and thank you everybody for supporting us as well. You know, we appreciate obviously what you've just said there, Tony. But obviously we're here without the support of the intermediary market, we wouldn't be able to lend. So we're a team in this, and that's the way that we look at it as well. So thank you all as well. So great working with you.
Okay, we're now just going to move on to our final speaker, who will be added. So Kerry, you're going to disappear from us in a second. And our next speaker will no doubt come up. Hopefully, it's actually going to be a human being, because as you can see, this is the picture he sent me over. So I'm going to introduce now Jim Nash from Tuscan Capital, somebody that I've known for, blimey, I think sometime in the 90s is the first time we met. One of the loveliest guys, and also loveliest guys, but also one of the most popular guys in the industry as well. I've never heard anyone have a bad word to say about this guy. He is undoubtedly a legend in his own lunchtime, to be honest with you, because he does like a pint, especially on a Friday. You can never go hold of him after 4 o'clock on a Friday afternoon, because he's no doubt with a broker, sipping a couple. But there he is. Okay, I think actually, Jim, that what you've had done there looks more like Prince Charles than you. So it was certainly pre-COVID. I know that much, right? Okay, so. Everybody, if you can just find the Tuscan Capital, it's a one-page document. Looks a little bit like that. It's the inside the box solutions and outside the box solutions that we've sent to you by post and also via email. First off, a little bit of an introduction to Jim, an industry veteran of many years standing, Jim has experienced firsthand all the ups and downs of recent and not so recent financial services history. The majority of Jim's experience has been gained in broker-facing sales roles, including time spent with National Mortgage Bank, prior to my time, that one, non-conforming lenders I Group and Money Partners, which is where I first met Jim when he was at I Group, and bridging provider Omni Capital. He's brokered a bit in his time too. He's a dedicated follower of the bridging industry, Spurs, golf and Guinness. And not in that order of priority, obviously, because I've already mentioned what he normally does on a Friday. Believe me, Guinness is right up there. Recently married as well in recent months, which he didn't include in his most interesting fact. But his interesting fact is this one. This is how you can tell how old he is. Jim was once on TV in a choir and sang with an old group called the Beverly Sisters. The programme was Stars on Sunday. He was, however, only allowed to join the choir if he promised not to sing. Now, he's also promised not to actually sing at all today during his presentation. And just in case we couldn't see him, I found a picture online of Jim that, again, was obviously pre-COVID. And there he is. So, Jim, I will just find your slides and then it's over to you. There you go.
Okay, right, thanks Tony. Let's just hope I know how to move these slides along. Right, well, I think Tony's already introduced me. I've been around for a little while. And like one of our previous speakers, something interesting else that happened during lockdowns, I became a granddad. So lockdown hasn't been too bad, if I'll be honest with you. Right, keeping this short and sweet, Tuscan Capital, been through the lockdown. We had a situation where we did take advantage of the furlough system for a couple of guys, but we're all back now, back working. And as with many lenders, we have during this time taken a view at our working practices, and we will be working from home in many instances. And me personally will look to go back into London maybe once every couple of weeks, most probably. And we've also enhanced the system so that we've become more automated. But anyway, that's it from a procedural point of view. Tuscan has been going now only for a couple of years. We are a small lender, unregulated bridging, set up by a guy called Colin Sanders, who was behind all of those previous companies that Tony mentioned, that National Mortgage Bank, Money Partners, etc., and most recently came from Omni and then set up Tuscan. And I have now been with Tuscan for a little over a year, excuse me, covering the entire country. We don't actually lend in Scotland, but England and Wales, and that's really it. What I thought I'd do is, rather than go through the specific criteria as such, as interesting as it might be, as you are all aware, bridging by its very nature is not prescriptive. It is, well, we like to think we're not prescriptive. It's a case of, what is the deal? What does it look like? Does it make sense? Etc., etc. And if it does, then we will try and make it fit. Where does it then fit regards costings? Well, that's down to a risk rate scenario. But generally, we would look to start at that 0.75% that you can see in front of you. And rarely, in fact, in my time there, we've not actually been at 1.25, but it is there for certain situations. Right, at the moment, having moved back into the market, we're now at 75% of open market value. When I say back into the market, I'm talking about residential-based type properties, HMOs, buy-to-lets. At the moment, commercial is a very, very difficult area. Not many people, because of, as I just said a minute ago, going back into town, going back to offices, we're not sure how this is going to pan out, especially with an announcement that might be coming along now today. And who knows what the next 6 months will bring. However, as I say, we're at 75% on residential. We will also look at semi-commercial. As a rule of thumb, we class semi-commercial as where 40% of that property will be commercial and 60% or more will be residential, flat above a shop. On that type of property, we wouldn't look to go beyond 70% at this moment in time. Moving down, you can see that we will consider foreign nationals, expats, etc. We'll even take a look at pets, depending on how pet they are, shall we say. It's something that they will always have to undergo higher due diligence, obviously, but being a pet does not preclude you from dealing with us. Credit approved term sheets, the way that we work, there's no real secret to it, is we're a small team. The credit approved term sheets are by way of the phone calls taken from the person in the office, whether it be the underwriter or the in-house sales representative, who will turn out, if it's in the office, and say to the CEO or finance director, will we do this deal? And the answer is yes. The credit back term sheet goes out straight away. We're allowing ourselves 24 hours just in case, obviously board meetings, etc., to get hold of the CEO or the FD. So moving on. Okay, what will we do? Okay, we'll do refurbishment, as you can see here, and I'm going to speed this up so as we can maybe get on to any questions. Maximum loan to value at the time of lending is 70%. And we work to a rule of thumb, which is this, is that the actual refurbishment work must be less than 100% of the current value. So buying something for 200,000 or 300,000 and spending 500,000, 600,000, 700,000 on it to improve, obviously increase the GDV and sell, is not the market that we're in at this moment in time. And again, you can see other preclusions there. We don't do ground up development at the moment. It's a time consuming operation. Having monitored this at my previous company, we don't have the staff to do that. And it's not something that at this moment in time, we're actually going to be entering into either. You can see there, projects must not increase the total square footage by more than 20%. So it's quite restrictive of the amount to be spent to improve the value and the actual size, because if you're increasing it by too much, then obviously we view that as then becoming a full-blown development type project. Okay, we like to see some experience from the guys that are doing it, and it's something which, yes, we will monitor. Any cost overruns we're looking for the client to cover, but it is one of those propositions that we do have in our armament if you need it. Sometimes I think it's easier to actually look at the type of deals that we've actually done. It gives you a flavour for it. Here we had a refinance facility. It was a development exit facility. The client was into penalty interest already with the existing lender. We agreed 70% loan to value day one. Now, that is not something that we would always agree. Each circumstance is looked at on its individual merits. But the merits with this case was that one of the properties had already been pre-sold. And we knew that once that pre-sale had gone through, then we'd be deleveraged. And it brought us back to, at the time, it was somewhere nearer 65%. So that is a case that we looked at, we completed on. Generally speaking, if we are refinancing something else at this moment in time, we'd most probably look at 65% unless there's an exceptional circumstance, as was the case in this one. This one here was an interesting one. You can see here what the money was raised for. You've got these two adjoining semi-detached properties, split into 16 self-contained flats. The properties were significantly downvalued because it was in terrible condition. In fact, I've looked at my notes here again. The surveyor has reported it as in his top 3 worst properties that he has ever seen. It was being run as a HMO, although without a license. It had some ASTs in place, some were out of date, some weren't. But we looked at it and we looked at the client, a very experienced property developer. He had a significant buy-to-let portfolio. He was actually a fairly local, he was actually a rabbi, actually, a fairly local guy who could prove how experienced and professional he was. So what we agreed was to do the deal, and at each stage, and we put it into the offer, we said that he was obligated to bring the back properties to a required condition, and then as he did that, we set timelines on it. He adhered to the timelines, and then he went back in to get retrospective consent, which is what he actually did do. And true to his word, he refinanced out with a high street lender who was more than happy to take him on board because of his past experience. And we oversaw it with our asset manager, and it was just an interesting deal. As I say, it was very interesting what the surveyor said about it. So moving on to the next example, this one here, we're not actually sure why this person could not complete within the 28 days of the exchange at auction. However, a pack was there, ready for the solicitors to move on, and we did provide the funds in 5 working days. If I'll be perfectly honest with you, I don't really like these examples, because when you see any lender says, we complete within 2 days or 1 day or whatever, there's always mitigating circumstances for it, but it just looks good on a headline, complete deal within 5 working days. I recently saw, that's a silly question here. Yes, I do know Richard Davis, whoever said that. I literally, on this one, as I say, we don't use it as a real example, but it did work. It worked with a surveyor who, we have certain surveyors, I mean, we've actually got 50 odd surveyors who are acceptable to us, but we had a surveyor who went into this one on the Saturday and had to be brought back on the Monday. Solicitors already had the pack, and yes, we did complete it within 5 working days. As I said, I was keeping it short and sweet because bridging, as we all know, is not prescriptive. I've rather answer questions to people because, will you do this, will you do that? And I'd rather be reactive because there are so many scenarios that a bridging company can work within, which obviously your high street lenders and your prescriptive lenders can't deal with. So, Tony, any questions?
You answer them in case anyone can't actually can't see the question or can't hear, well, can't see, for example. So, excuse me. Hi, Jim. Is the 40%, 60% rule on semi-commercial, is it based on the monetary value of the commercial, and or is it the commercial resi, or the floor space?
Yeah, good question. Monetary value.
Monetary value. Okay, yeah. Good. Just say hi to your wife walking in the background there. Robert Smith said, what do you mean by experienced developer? I think that's then for the refurb product. Yeah,
do you know what? We actually, as a rule of thumb, have they done 2 similar type projects previously? A rough rule of thumb.
Okay.
Succinct answer?
It does, yeah. I'm just going to just ask one more. I've got one more pre-prepared question, which is, what happens, and you might have answered this sort of like partly anyway, but what happens if a loan term needs to be extended for any reason? What is Tuscan's stance in this situation? Okay.
But at this moment in time, if we go through where we're at with COVID, etc., have we been asked for payment holidays? Funny enough, we've only been asked for 2. And on one of them, no issue at all. There was a reason for it. It's actually, and you can look this one up, unfortunately, it's the equivalent of a nightclub. It's an entertainment centre up in Blackpool, very famous. And of course, you can't get people in. This is a place that was turning over £250,000 over the weekend. And all of a sudden, making the payments to us, it's just not going to happen. So we're going to live with it. Hopefully they'll open up soon and they'll be doing catch up. In this situation, as I say, with this cut, it's quite a significant size loan. They just don't have the money, and we're just going to forbear with them. There's nothing we can do. As an other end of the spectrum, we actually had a holiday payment request from somebody that, when we completed the loan, and I know it really well because it was one of my deals, didn't want to disclose all of their assets, etc., because they were such a high net worth individual. why should they? And, you know, I don't know why they're so reticent about it. So when you come along and say, right, can I now have a payment holiday? It was, well, if you remember back 6-7 months ago, you're a high net worth individual who don't want to disclose all of your income. The payment turned up 2 days later. So, but we are forbearing on that, number one. Number two, in normal circumstances, if one needs to extend, I'm not going to say we don't have an issue with that. Everybody has an issue, but of course we will extend. We try and be cooperative with the client. Again, we charge, you know, like our peers we charge, but we think that we are very fair. We would only look to charge a 1% extension fee, and I know compared to many of our peers, that is significantly less than what they would look to charge. We only like to extend once, so if the exit hasn't been fulfilled the first time round, we really do look for it to be fulfilled the second time round. Again, however, present circumstances, we've extended a couple of times the ones that we've already extended on, obviously because of the situation. I think as a lender, especially as a small lender as we are, I would say, a lot more cooperative than maybe some of our peers. Maybe because, as I said, we don't have a collection department. Let me put it to you that way. We have an underwriter who underwrites, and then who will actually, if a deal needs to be discussed and agreed and extended, will also deal with that part of this of the project as well. So there you have it. Okay,
it probably helps that the team you've got at Tuscan does know what they're doing. I mean, Colin Sanders, the CEO, was previously CEO at I Group, Money Partners. For those who remember, Money Partners for about a 2-year period back up to 2007. And Omni Capital, which was backed by the Candy brothers. He's been CEO all three. Stacks and stacks of experience going all the way back to the 80s, and he knows his stuff. We've unfortunately seen some bridging lenders, or had some applications where we're looking, the clients looking to exit a bridge, and they are being absolutely caned on charges, on interest, and there is just no leeway with some lenders at all. Tuscan are very, very different. Very, very different. Okay, so we're way ahead of time. We've actually did skip one of our slides there, Jim. You skipped past the most important part, which is how to submit business. So once again, delegates, for all your Tuscan Capital documentation needs, just go to the usual place. That's also on the inside, outside the box flyer that we sent you. Everything you need as far as the documentation for placing a deal with Tuscan, which obviously we want to come through us, because Tuscan pay us slightly more and they will pay you, or not slightly, they pay us more and they will pay you. Yeah. And if you want to say the 0800 numbers there, again, that's purely for Tuscan, so it goes through to the right team straight away. And also you can email us from Tuscan, and then we can see it's a Tuscan query. Okay, so again, once again, just go to the lenders.specialist hub section of our website, and everything you need will be there. Jim, there's no more questions, so you've obviously covered absolutely everything. Thank you for having a very bright window behind you. It did actually make you look like you was somewhat holy at times. So I was going to take you out into the garden, to be fair, Tony, but I thought you'd think that's much too relaxed of me. I mean, this is the first time, like our previous, I've actually worn a shirt in 6 months. Is the truth. When we did the Zoom call the other day, when we was practicing this, she was actually, he was probably semi-naked, so I'm not quite sure. Anyway, let's not go there. Jim, thank you very much. We're now going to have the final part, and we are way ahead of. I've actually had one question, Robert Smith. Many thanks. Robert, we've not finished yet, by the way. So do you have a team that would help us decide which lender where it may fit more than one of your panel? Robert, coming on to that right now. So Jim, you can go and help with the washing up. I think Charlie was doing a bit of washing up at one stage as well. And I'll then now crack on with my bit.